The economic repercussions of the COVID-19 pandemic have thrown the world economy in a heavy recession. Worldwide, central banks lowered their interest rates in order to help governments finance huge stimulus packages to get the economy back on track. With the recent signs of economic recovery and rising inflation, some reputable economists in the United States prompt the Federal Reserve to increase interest rates. But is that a valid reasoning? Generally speaking, there are two main reasons for a central bank to adjust interest rate upwards in order to dampen the economy. First, a positive output gap, which means that the economy is overheating and producing above its potential. And second, an inflation that exceeds the central bank's target.
Let us first have a look at the state of the economy. The US GDP has bounced back from the heavy slump in 2020, but is not yet where it would have been in the absence of the pandemic, as indicated here by the trend. Moreover, employment has recovered, but the recovery has settled at 58%, well below the long-time level of 61% before the crisis. Also, as an example, consumption expenditures show a similar development. These mean that the economy is still not producing at its full potential, and we have a negative output gap.
It seems that the US economy could still use low interest rates to support the economic recovery. Hence, from that side, it is not recommendable to increase interest rates. But those economists that argue for an interest rate increase are more concerned with the inflation rate, which has been going up above the Fed's target lately.
Following the decrease in the beginning of the crisis, inflation has gone up quickly in the last few months and is now at 5%, well above the Fed's target of 2%. However, there is evidence that this is not as troublesome as it sounds. Firstly, the year-on-year inflation that we see here is currently influenced by the very low numbers 1 year ago, which means that high inflation right now is partly due to base effects. Secondly, the inflation rate is strongly influenced by the volatile energy and food prices at the moment, which is why the Fed excludes these prices in their target measure. Doing that leaves the inflation rate at 3.8% currently, still above, but also much closer to the target. Another potential inflation drivers are the stimulus packages from the Biden administration. More precisely, the one-time checks given out to consumers. These checks are able to increase consumption expenditures and GDP, but looking at the development of consumption, we can see that the stimulus packages have not yet had a big impact, and the output gap is not yet closed nor turned into a positive one. Hence, there is little risk of high permanent inflation from the stimulus packages. Additionally, as the crisis disrupted global supply chains, US companies report high trade costs at the moment. These price increases, however, should only be temporary until global supply chains are restored.
As we have seen, the high inflation might very well be only temporary, which is quite common when an economy is in an upswing after a recession. This, taken together with the fact that the economy has still not fully recovered, means that the Fed should not raise interest rates right now. Nonetheless, once the output gap is closed and prices still rise, this conclusion might need to be reconsidered in the coming months, and the Fed might have to step in.